Well, our crypto strategist, Sean Farrell, still writes about the 4-year cycle. And it's, it probably doesn't matter between now and the end of the year, because in any case that we should be seeing a lot of strength. But I would say that the real test, there's really two tests that will come up. Is one, is Bitcoin going to follow a price cycle next year, which would be a downturn? And is Bitcoin going to diverge from the equity markets next year? And I think that there's a chance that both take place, and that's why we'll be talking less about a cycle, because as you know, Bitcoin also historically followed equity markets pretty closely too.
Fundstrat's Tom Lee has been right on crypto before, and now he's back with some of his boldest calls yet. He starts with the so-called 4-year cycle. Originally, that idea came from Bitcoin's halving events. Traders assumed each halving would spark a new cycle, and because they expected it, they traded that way. The pattern reinforced itself. Lee compares it to traditional markets, where institutions still lean on seasonal trends in equities, credit, or volatility. For years, Bitcoin followed the same reflexive logic. But things are changing. Many veteran crypto analysts now believe the 4-year cycle is breaking down. Why? Because the marginal buyer isn't retail anymore. It's institutions, and in some cases even sovereign players. That shift changes the dynamics completely. The real test, Lee says, will come next year. Will Bitcoin follow the old script and slip into another downturn? Or will it finally break free, both from the 4-year rhythm and its correlation to risk assets like equities? Historically, Bitcoin has moved in sync with risk on markets. And in past crashes, it was brutal. Bitcoin fell 70 to 90%, with altcoins dropping even further. But Lee points out that this time could be different. With institutions and possibly governments now accumulating, downturns may be cushioned. Think of how the US fills its strategic oil reserve when prices are low. Big players could treat Bitcoin the same way. If that happens, the story of crypto shifts. Instead of a predictable retail cycle, Bitcoin could become an institutional asset with its own rules. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
When I was at JP Morgan, there were many conversations about Bitcoin when I was the chief strategist, and we had our macro calls. Which
I remember that.
Yeah. And our FX strategist at the time said that Bitcoin could become recognized as a digital currency someday, but the problem is that it's principally used by drug dealers and the dark web. So it was really deemed as a experiment, but only used for nefarious ways. Although people forget that pirates basically innovated gold. So I think it would have been impossible to actually have a view on Bitcoin and a firm like JP Morgan allow someone to actually publish the white paper we did publish in 2014. I know we also faced commercial setbacks when we wrote that first white paper on Bitcoin, and Bitcoin was under 1,000, but we said by 2022, so 5 years forward, the range of fair value was 22,000 to 66,000 for Bitcoin. But we said that, if you triangulate it, it would be roughly 25,000. We had clients actually cancel service on us. So we had some hedge funds famously tell us that they knew that we were so desperate that we lost all of our credibility because now we were talking about internet money as if it was a legitimate asset class. So it actually hurt us, and it probably didn't become a benefit for us as a company because we committed resources to it continuously since then until maybe 2021. Well, I think when people talk about a crypto cycle and it being 4 years, there's probably some reflexivity at work because the original genesis was that, Bitcoin had a halving cycle. And so people were talking about a price cycle that really followed a Bitcoin in the halving. But in crypto, as you know, because there isn't a company, it's decentralized and there's no centralized source of information, price itself often becomes really important, especially in the early days. So I think that there was a lot to people looking at patterns and then markets trading on those patterns. And the reality is that it's still true in the equity world because I can't tell you how many of our institutional clients still look at seasonality which is just applying a calendar to what price action could be, either whether it's credit or volatility or equity. So every element of liquid markets today. I think that there is probably some credence because many people are positing that the 4-year cycle may not be in place anymore. Everybody from Bitwise, to David Bailey, so a lot of OGs, and that has to do with the fact that the incremental buyer of Bitcoin is no longer retail, which was really the story from inception up until probably 2024. And so now in the last 2 years, there's now institutional allocations taking place into crypto, and because of that, it's probably countercyclical. Well, our crypto strategist Sean Farrell still writes about the 4-year cycle, and it probably doesn't matter between now and the end of the year, because in any case that we should be seeing a lot of strength. But I would say that the real test, there's really 2 tests that will come up. Is one, is Bitcoin going to follow a price cycle next year, which would be a downturn? And is Bitcoin going to diverge from the equity markets next year? And I think that there's a chance that both take place, and that's why we'll be talking less about a cycle, because as you know, Bitcoin also historically followed equity markets pretty closely too. Yeah, again, and now we're being theoretical because I'm not necessarily calling for a correction or a crypto winter. The past crypto winters have been really painful. Drawdowns or declines for Bitcoin from the peak of more than 70%, maybe 90%. And the altcoins and non-Bitcoin doing far worse. I would say that it's not just institutions that are coming and buying Bitcoin now. I think that there is sovereign purchases of Bitcoin taking place, and the U.S. government, while hasn't completely articulated its strategy for building a Bitcoin strategic reserve, but we know the U.S., when oil prices are low, they are a stabilizer for oil because they are filling that SPR or strategic petroleum reserve at low prices, and that always puts a floor for oil. If Bitcoin enters a winter and the U.S. pursues a budget neutral strategy to acquire Bitcoin, that means they'll be really active buyers of Bitcoin at lower prices. So if you always have a buyer at lower prices, you're kind of bounding your downside.
Tom Lee says Bitcoin and crypto have long tracked global central bank liquidity. That made sense when the main story was digital gold or simply another risk asset. But things are changing. With institutions, and even governments, now stepping in, the old cycle dynamics may be breaking down. Lee compares it to venture capital and private equity. Before big pensions and sovereign funds entered, those markets had clear boom and bust cycles. Once institutions allocated real money, the pattern shifted permanently. He believes crypto could be in that same transition. On the debt side, Lee makes a point most investors don't like to hear. Just like a company can load up on too much leverage and eventually choke, nations will hit their own breaking points. The only questions are when it happens, and whether it's inside a time frame that matters for investors today. Looking further ahead, Lee takes a broader view. He thinks AI could be deployed to solve some of the world's hardest structural problems, inequality, food, and shelter, if it's used in a benevolent way. And he ties that idea back to crypto. In a sense, Bitcoin and Ethereum already acted like a primitive form of universal basic income. Early adopters gained wealth without labor, simply by being early participants in the network. It didn't reach everyone, but it shows a possible model. Future cryptos could expand on that, distributing wealth more widely, almost like a digital safety net built into the financial system itself. Let's get back to the interview.
Foremost, I've seen those charts with global central bank liquidity and Bitcoin, and Raoul Pal, I think advances at 16 months, and it's been pretty dead on in explaining crypto. And so I would say that in my mind, it's intuitively logical that global liquidity is a reason why crypto prices do well. Okay. But I think there's a second story arc developing in crypto, which is that was also true when the singular narrative for crypto was, well, it's digital gold, or it represents a vector of trust or of risk appetite plus it trades 24/7. And so that's why we want to look at it. And, maybe that's why people look at it and describe Bitcoin. But now I think that the narrative is changing for a couple reasons. One would be the institutional sponsorship of Bitcoin plus government sponsorship. To get you a template on that, look what happened to venture capital and private equity. Venture capital used to be very predictable cycles, and private equity too, because it was primarily family offices buying it and selling it, and it was very short cycle, and they couldn't, they never really raised a lot of money. The minute it became an institutional sector, it has completely transformed the cycle in venture capital and in private equity. There hasn't really been a private equity cycle since you've had institutional flows into the private equity sector, and now private equity is larger than cash equities. But I think the second story arc is that AI and adjacent to it is financial innovation. Like these two really huge story arcs are starting to take place. Like AI is such a big deal because it's for the first time it's creating worker equivalents. That means you're not only relying on demographics to drive labor force growth. And at a time when the financial industry now has the green light to really reimagine itself. I mean, as you know, the financial industry's biggest cost is humans and money their endeavors, right? It's the biggest expense is compensation expense. You don't really have to pay a robot bonuses.
Sure.
And a lot of that is going to be running, and especially because of the need for both authentication and really shifting trust on blockchain. So I think that is why I think there's credibility to the idea that we should still respect the cycles and central bank liquidity, but now I think that crypto is really breaking into much more meaningful use cases. Look, we know at the micro level, debt is what strangulates a business. I mean, like, let's just take Meta. Like, let's say you have Meta and it's the best company in the world, and if their balance sheet had debt to sales of, whatever, 500% or 300%, it would be very difficult to operate as a company.
Sure, absolutely.
Because the CFO is worried about the debt all the time, and they're going to make suboptimal decisions. So like, capital asset, cost of capital models all go out the window, because when you have too much debt, it's essentially crowding out the ability of that company to operate efficiently. So I think that there should logically be a break point where nations or economies or governments become strangulated by the debt. But we know that there is a break point, but I don't know if that break point is in our investment horizon, like in the next 12 months. And then I would say that in the back of my mind, I am thinking and aware of a couple of things. One is that AI is so transformative, okay, and we can imagine so many scenarios. I'm going to still assign, like, I think an 80% probability that we get the benevolent case of AI. And that AI benevolent case is that it solves a lot of the structural problems of inequality, like that. And I know we're diverging, but like if we have robots that are planting and work on farms 24/7, we won't have people starving. And they can also agentically be building shelter, and we solve shelter. I would say that's a huge positive outcome. And then the third, of course, is the question about UBI. Okay. And I'm going to introduce a strange concept, but I actually think crypto is already proof of UBI, because Bitcoin and Ethereum are already examples of UBI. See, people bought these things early, and now they've created, have enough resources passively without actually doing any work, except being, a believer in the community, that it pays for their own subsistence. I mean, in many cases, fabulous subsistence, but it's actually, I think crypto is UBI in that argument. It's maybe it didn't reach everybody, but everyone had a chance for that. And in the future, there'll be, I think, future crypto that creates UBI as well.
Momentum in digital assets appears to be shifting from familiar retail-driven waves towards something far larger and more structural. What once looked like a pattern tied to predictable halvings and speculative enthusiasm now faces the influence of deep-pocketed allocators, policy decisions, and strategic accumulation. This change doesn't just alter the rhythm of price action. It reshapes the very nature of the market, making it less about hype cycles and more about long-term positioning. At the same time, the looming question of sovereign debt sustainability and the potential role of technology like artificial intelligence adds another layer of uncertainty, but also of opportunity. In this landscape, crypto is no longer a fringe curiosity. It's edging into the core of global finance, where its behavior could start influencing rather than following traditional markets. Could this be the beginning of an era where digital currencies set the tone for capital flows, rather than simply mirroring the old order of stocks and bonds? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support and I hope you enjoy the video.